would like to welcome everybody here to the Total Partners Winter Luncheon. And we've got a few guests before we start. I'm going to introduce. We also have Clint Privet here. Clint's a landman, an attorney. He's working with us. He's my partner in the Horizontal Partners Project. He's the one that has been doing the lease acquisition and the due diligence and the negotiations for the leases for all of the participations that we're in Total Horizontal Partners. And he'll be assisting in that presentation today in the second half of our show. Okay, you will not be able to read what's on this because the numbers are very small. And that's the reason we had one of these printed for everybody here, the spreadsheet. This is our Total Horizontal Partners 24-25 fund working interest portfolio. And we're going to go through this. Clint's going to assist me. As we discussed before, Clint's a landman, attorney, CPL. What's the other designation you have?
I've got an LLM as well.
LLM, yeah. So he's got all the education. But we have developed relationships with a number of, and this is through Clint's assistance, because he's been in the land business for over 10 years now, correct?
Yep.
And we've got 2 or 3 lease brokers, companies that specialize in going in and leasing under these major players that we've developed relationships. We've also developed a relationship with at least one of the operators so far and have been invited. We're going to go down to Oklahoma City here within the next few weeks and meet with the principals of Duncan Oil. They're interested in showing us what they have directly, so we kind of get out of the loop of buying the leasehold underneath. But in most cases, that's about the only way you can get into these major plays, because they operators, I mean Devon and Continental, that these are companies that don't need our capital. Same kind of question that I got asked on Adams Creek is, well, why does Continental Resources need our money for their deal? They don't. But they have to deal with it because that's the law. So anyway, let's take a look at this. The ones in green at the top, those are the existing participations that we have. And we can go by column on here, but the first is the section, the township, and the range, which is the legal description. And then, of course, the county. And all of these in this group, except for the Canvas Energy, are in the Anadarko Basin. Is that correct, Clint?
The Continental is at the tail end of it. Sometimes it's called the Marietta Basin, but it's essentially an extension of the Anadarko Basin.
Okay. This is the play that we've talked about, and we could put the map up, and maybe that's what we should do. We do have hard copy for people that are interested. We also, of course, have distributed this through digital copy, but we brought a couple of these. We also have, I forgot to mention, a hard copy of our Adams Creek prospectus as well here today. So let us know if you want one of those. But anyway, going across, you can see the counties that we're in: the Custer, Roger Mills, Ellis, everyone except the Alfalfa, which is the Canvas. And you may recall that a lot of you in here are in Total Production Partners, and we just had a lease sale. In fact, that's on our handout today. We've actually returned in 7 months. We've returned 24% cash. That includes its production revenues, and it includes a leasehold sale of some of the Mississippian rights that we acquired in that acquisition from Continental Resources. We have another 6 to 8% that we're expecting the balance of that leasehold sale to occur within the next 30 to 60 days, which should take our total rate of return to something over 30% in about 8 months. And our production's been improving there too, so that's turning out to be a really good deal. We did the same participation here, which is the Roadrunner well, and a lot of you will recognize that because we did a separate offering in August of last year and took advantage of, again, Mississippian rights in Alfalfa County that we had acquired from Total Production Partners. So we got to secure that, and we picked up 6.25% of the working interest in the Roadrunner well. That well was drilled, completed in October, and as of January the 15th, had produced, I think, a little over 50,000 barrels and 150,000 MCF of gas. So it's clipping along at about 10,000 barrels a month right now. We anticipated distribution and Roadrunner partners, which this has been announced, but I'm just giving this as reference to what we're doing here, which will be the same kind of, be on the same basis as we will get a distribution and horizontal partners. Typically, all of these deals, and some of you may remember this from previous discussions, but operators under the Oklahoma Corporation Commission under state statute are required to make a payment of revenues within 6 months of the inception of production of the underlying well. Well, we've been in this well now for 5 months. So within the next month or two, we're going to be getting a distribution that will be the cumulative total of all the production to date. We anticipate that rate of return, cash on cash, to be something in the neighborhood of 30%, possibly more. It's hard to calculate what we're going to get on the gas yet, but we're talking about the gas. We're getting all of these plays out here have got really rich gas. So it's not just oil, but gas is becoming a significant component of the income stream because gas has been going up. And rich gas gets a premium over dry gas. So that's been working out well. But anyway, so we'll have a pretty substantial cash return versus our investment starting and here within about 30 to 60 days on that Roadrunner. So anyway, going across to follow up there, and this was also reported, Craig Van Horn called me it's been about 2 weeks ago, and he said, I've got some more good news. In addition to the Mississippian rights we're selling to this venture capital group, we also have been notified by some other operators that they are wanting to acquire acreage mineral rights that we have under other wells in the area, additional 5 more, similar to the Roadrunner. And now that'll give us an opportunity to include those. That's more potential inventory for our total horizontal partners. And also that's more of value to the people that are in production partners, because every time we make one of those sales, we pick up more value from our leasehold rights. So, any questions? Does anybody understand what we're talking about here and how our deal's working? Okay. Everything we're doing here, as always, is at cost. The only markup, there's not a markup. We charge 5% as an organizational fee. I believe the terms on this are like the Adams Creek deal. We have a preferential return, cash back plus 10% before a 20% back end. Clint, you might talk a little bit about some of the experience some other people you know are having with the kind of returns they're getting on some of these wells in the area.
Yeah. Some of these wells are coming in really strong. We've talked about EURs a little bit in the past. There are some out there that have million-barrel EURs throughout the play. It's still a developing play, so they're still testing the boundaries of the entire area.
Tell them about EURs. Some people may not be familiar with that term.
Okay. It's essentially the ultimate recovery, the estimated ultimate recovery of a well in its lifespan. So if it has a 25-year lifespan, over the course of its life, it should return between 500,000 and 1 million barrels on a lot of these. The low estimates, and again, it's pretty early in the play to have an ultimate result of how much it's going to actually return. But the low end is between 250,000 to 300,000 barrels and 2 billion cubic feet to 5 billion cubic feet of gas. And we were talking about gas prices earlier and the premiums that some of these wells are seeing. You see, natural gas prices per million cubic feet over the last few years have been hovering around $2 to $3. Today, I think we're over $4. And like Scott was saying, with the rich gas on some of these wells, the value that's coming out of them is about 50% more than market price. So if we're at $4 today, the wells would be paying about $6.
We even saw a revenue run from what was it, October, November, December for one of the wells?
Yes, and they were getting about $5.50 per MCF, which is about time and a half of what the market is.
Yeah, we were looking back at the market price then. Yeah.
So one of these $12 million wells, how many at today's prices barrels of oil is break even? Roughly, ballpark.
At $70 oil, I'd have to pull out my calculator and then tell
Well,
you.
if you do 100,000 barrels at $70, that's $7 million. Okay, and if these wells have a $500,000, that's 5 times 7. That's $35 million in gross. And so you can work backwards from that. We've got a 75% net revenue interest, so that's going to be a quarter off that. And take 95% of that. There is a tax incentive on new horizontal drilling in Oklahoma, and instead of 7% or 709, whatever the state tax is on the oil and gas production, it's 5% on new horizontals for how long?
I think 36 months.
For 3 years. So, so we're getting 95% instead of 93. But anyway, I can work up a break-even number for you.
Just because we were talking about barrels.
Right. If you get, I like to think in big numbers. If you get a well that does 1 million barrels, if the well's at $70, that's $70 million. You can drill it for $12 million, even though there's, you're getting 75%, and you're paying taxes and all that. Turns out to be a profitable deal. Yeah. Some of these, Clint has tell them about a couple of your lease broker buddies that have participated in what they.
So a lot of the guys that we buy leases from also buy leases for themselves and keep small percentages as they can afford to invest as well. And as we were saying, the Production Revenue Standards Act gives companies 6 months before they have to pay their owners. And in that 6 months, a lot of the wells have either come close to or hit the break-even point with the first check.
You may recall that, Mike, you were in, I'm trying to recall, were you in the 2000, I believe it's 11 fund that we did? Yeah, what's that, 14 years ago? It's now part of
I was
DevCap.
like 2 years behind that, I think.
Okay. Anyway, Richard, I remember we bought that Devon interest out in the Granite Wash in the Texas Panhandle, and that thing came on at 700 barrels of condensate and 20 million cubic feet of gas a day. And we got all worried. We'd never played that game before. We bought it through Crown, who we're doing a lot of business with. And we sat there every month, well, when are we going to get a revenue? We kept waiting, and months went by, and after about 6 or 8 months, we finally got a check. Now, of course, it went into the fund, so it wasn't like you realized it was diluted by the rest of the fund's performance. But we ended up getting our first revenue run, I think, paid for our interest. And we paid for that. And so there is some good upside in this. And the one thing you know about drilling horizontal wells is that you're going to make a well. And it's just a matter of how good the well's going to be.
Right. The only one that we have real numbers on right now is the Roadrunner, which is in the Mississippian, so it's not specific to the formations that we're chasing in the Anadarko Basin, but based on the numbers that we see, it's 6 months, 30% return.
That's and it could be more than that. We always try to underpromise and overdeliver, but I think that's a conservative estimate. And also, the Mississippian it's a shallower formation. I think it's around 7,000 feet. And I believe our AFE it's on there was 7.5 million. Mm-hmm. So it is a 2 mile lateral, but that's not as deep as we're going. As you know, as you go deeper, the reserves are better, the pressures are better. This stuff in the Anadarko, there are wells. Tell them about that Barrick well that's in the nearby area.
The Barrick well is one of the wells that were drilled, kind of testing the periphery. So it's in Custer County, in the eastern part of Custer County. And it came on at over 1,000 barrels a day. It's been producing for 6 or 8 months and has averaged around 600 barrels a day for 6 months. Again, it's algorithm based, but the estimated ultimate recovery on that is about 975,000 barrels and 11 billion cubic feet of gas.
So if we can make a well that does 1 million barrels and does 11 BCF of gas, I think it's safe to say we'll make some money. Yeah.
Scott, I don't understand the proportion of total horizontal partners.
Okay.
We take investments from us. Mm-hmm. Say you got $1 million.
Right.
Well, and we add more wells to there, we're gonna,
Right.
you haven't spent the million yet, how do you know?
Well, no, first of all,
How do we get into
well,
each
right here,
well?
if you look, everything in green has been funded. This is money that we raised effective the end of the year, 2024, December 31, and that figure is net of $567,928. We've already paid for the leasehold, paid for the drilling and completion, and prepaid it, and we're deducting about 85% of that will be on our tax return. Shauna, make a note of that. Tell Clayton to make a note of that. 85%, guys.
So new ventures now what, then we've gotta raise more for the new ventures?
Well, for the new wells, we will be raising more. And this is exactly the same format that we did when we first started. When I started back in 2009, when I met you for the first time, we did all our deals. Up until 2015, every deal we did every year had 2 calendar year closings. And we did the first, and the only difference is that the tax basis is different. In the second year, the people that go in the first year will get all of the IDC for the first wells, and people that come in subsequently, their monies will go towards new wells, and they will get the IDC. The tax benefit will not be as great in 25 because we're going to have income, but it will still be a net deduction, and I can't tell you how much until we get to the end of the program. The offering will be open until September the 15th. We'll make no cash distributions till then, and at that point, everybody will be pro rata, dollar in, on the same basis. So we'll make it as and this is all the deals we did before, everything that's in TechCap, all of that was done that way, which is really quite unique. I've never seen another structure like this, and Clayton helped me figure it out. He's over there hiding somewhere. But anyway, it's particularly, I think, appropriate now. We didn't have, if you recall, we didn't have these kind of connections, nor were these wells even in existence. I mean, we were doing horizontal wells, trying to do a 1 mile lateral and keep them straight. And I mean, the technology has improved so dramatically, but we didn't have the ability to buy under million-barrel wells with Devon and Continental and people like that. The technology wasn't there. So I think going back to our original model, this works really well. And it gives us a format where we can continue to take down wells and raise money throughout the year.
Until we close, the more wells that come on, if you only invested in the first one, your percentage of the total project goes down.
Well, that's correct. You're getting a smaller piece of a bigger pie. Exactly. But everybody's going to be on the same basis. And if you'll recall, up until 2014, we had kind of a pretty good run. Oil averaged about $114 a barrel for about 5 years, and we were, even though we didn't have the kind of product we have now, we were generating on average 50% return in 18 months, which was considered pretty good. I think we can do better than that now.
So is Roadrunner in both the deals? It's in the horizontal?
Yeah, we took down.
Both?
Yes, we took down Roadrunner, the initial leasehold allocation, and then the fact that we had that gave us the ability to elect to take the unelected interest in the pooling. And so there was, go ahead.
You want to explain that?
Yeah, go ahead.
So in a pooling, you have a 640 acre section, and instead of drilling these wells on 40 acre verticals, they pool the entire section of ownership within it. And in the case of these, it's 2 sections, so 1,280 acres. Not everyone's going to be leased. Sometimes you'll have lease owners who don't want to participate for whatever reason. They don't have the capital, they don't believe in the project, whatever it might be. And they will elect to not participate. So it goes back into the pool. And if you own the right to operate, a working interest owner, and you elect to participate, you also have the right to elect to take your proportionate share of uninterested and unleased, not participating ownership, which is where the acreage came from in this. There was 14.9 acres available for our proportionate share in
Right, we got 80
total
acres.
Roadrunner.
We got 80 acres in total Roadrunner, which worked out to be 6.25% working interest. what we got in the pooling was
Yes.
another, what?
15 acres.
15 acres, so it wasn't a big position, but
So instead of doing a capital call for Roadrunner Partners, Total Partners and the other entities that own that acreage sold to Total Horizontal. And so Total Partners and Total Roadrunner Partners will see a return, small, but that's who we're paying for our acreage here.
okay. Okay, any other questions on our portfolio and the way it's laid out here? We do have in the far right-hand column under the notes, these are comparable. These are wells in offsetting sections to us, sometimes directly offsetting, and these are initial results of wells, and Clint has the ability to track all of this. So tell them about the drilling info.
The way we get our information is from a data aggregator. It's called Inveris, or Drilling Info is what it used to be called. But they scrape all public available data on production through the Corporation Commission, through Tax Commission, and through various entities throughout the states, the lower 48, that report the data. And they aggregate it all together, and that's actually, they use an algorithm to give the estimated ultimate recoveries for a lot of these wells, which is part of the reason you take it with a grain of salt.
Yeah.
But generally speaking, it's in the ballpark. And so our baseline on most of these wells, the very low point is 250 to 300,000 barrels of recovery and a couple of billion cubic feet of gas. And if we stay around $4 in gas, that actually turns out to be a pretty big chunk of the revenue.
We get stuff offered to us all the time, and it's just a function of having the capital to take advantage of it. Tell them about the deal that we just took down last week.
This is a pretty interesting one. It directly offsets our other Lazy M well that you can see is fully funded in Ellis County. It's there in the middle of the green, and that one is one that was actually just drilled, and they are waiting on the completion for it. That'll be our first Anadarko Basin well to come online. And it has another well that is in the section next door to it, the Lazy M2326, that's made 30,000 barrels and 166,000 MCF in its first 2 months of production, so about 15,000 barrels a month. And this, in yellow, is directly to the east of it. So they're directly offsets, and we're kind of keying on the well that's in between them as what this well will produce. So 15,000 barrels a month and
We have
80,000
We
MCF.
have we got another one the other day. We said right now we can't take it because we just don't have the capital.
And that is the two at the bottom here.
Right.
These are two potentials, and they have direct offsets as well. It's not on here, but the direct offsets of those, one has been producing for 8 months and I think has made 125,000 barrels and 1.6 BCF. So it looks to have already paid out in its first 8 months.
So anyway, there's a lot of product here, and for people that are looking for income, and this will be monthly income, we'll distribute monthly. Our first cash distribution will be in September. We'll have money on hand by then. Everybody that's in prior to closing will get their pro rata share of that distribution. It'll be monthly thereafter. So a lot of this is going to come online as we go. But anyway, we're excited. I think the model is really going to work well for this, and assuming prices don't go from $70 to $20. You know, that's what happened. That's what kind of killed our model back in 2014. A lot of you were with us back then, and you'll recall that I think we raised about $10 million in 2014, and it went 300,000. It's like nobody wants to be in the oil business anymore.
Right.
Anyway, it's price of the commodities a risk. So
Speaking of risk, this is kind of a nice model when you talk about risk. As long as prices stay high, with as many wells and units that we're in, the risk is lessened over the
we have diversification across multiple operators, multiple wells in multiple areas, and chances are very high that we'll make wells in every one of them. The people that we're doing business with here or that are drilling these operators, they know what they're doing, and the technology, and I mean, the newborn is the 800-pound gorilla out here in the Anadarko Basin. They've got 9 rigs running full time right now. So they obviously believe in the play. There's also part of this play that's a red fork. And some of this is shale. They call it the Cherokee Shale. But they're also drilling the Red Fork, which is a sandstone, horizontally. And it is, they're making wells that are 1.5 million EURs, oil, plus gas. And pretty exciting play. Okay, guys, we're after 1 o'clock now, so has everybody gotten their dessert? No? Clayton, are you leaving?
Yeah, I am. I've got 1:30.
Okay, thank you. Shauna, thank you guys for being here. Appreciate it very much.
Thanks for getting the K1s out. I do receive them.
Okay, if there aren't any more questions, there's we're going to we're probably going to close the meeting, but we'll be here. Clint will be here. Matt will be here. I'll be here. If any of you would like to have some one-on-one discussion, we're here to do that. Okay. Thank you, everybody, for being here today. Appreciate it very much. And we're going to have a great year in 2025. All right.